We also live in an age of disruption, and that's been seen firstly in unconventional monetary policy, which has disrupted normal valuation levels. So ZERP and QE has disrupted financial markets.
Where I think we haven't yet seen the end of the Trump effect is on the fixed income markets, where the market has re-rated quite considerably in terms of its expectations of interest rate normalization. We don't think it's yet gone far enough. So the economic inheritance, if you like, that Trump received was a US economy that was in pretty decent shape. Not saying there were no imbalances, not saying there were no challenges, but it was in pretty decent shape, and inflation was already picking up.
You can take the side of it and say, okay, maybe as a strategist, markets are fully valued, Trump's impact is waning. But as a portfolio manager, every day you have to put numbers up on the board. You have to perform. And so what I would say is, that you could, some of the shine is definitely coming off the sentiment towards Donald Trump and policies, etc. But global growth momentum is very strong. You're meant to be long risk assets in this environment. I'd love spreads to be cheaper than they are, wider than they are, but the reality is they're not. And you just have to live with that. And if you think you're in a global recovery, you're meant to be long these risk assets.
And people always assume that certain infrastructure assets are bond proxies. And if they're bond proxies, they get beaten down when interest rates are rising. But actually, they don't all behave in the same way. What happens is, immediately in the eye of the storm, as we saw last November, there was this reflation trade that came off. And across the world, doesn't matter if you're based in Brazil or in the US or in Latin America and other parts, you got hit quite badly. But the inflation curve isn't rising in all markets. Interest rates aren't rising in all markets.